On November 18th, 2021, I posted this poll on YouTube and it says, do you think the next decade will be as profitable for stocks as the previous decade? Almost 300 of you guys voted, and overwhelmingly, 50% of you guys said the next decade is going to have less growth in the stock market. And it's not just the YouTube community, there's tons of articles like this. Bank of America outlines what could make or break an investor's ability to generate positive stock market returns over the next decade. To combat the potential 0% returns over the next decade, Bank of America says the number one thing an investor can do is reinvest their dividends. The simple act of reinvesting dividends could yield a total return equivalent to the S&P 500 at 6,000 in 2031. Hitting that mark in the next 10 years would represent a total return of only 36% for the S&P 500, or an annualized gain of about 3%. That's just a fraction of the past decade's return of 360%. A major contributor to this sentiment in the market that the next decade is potentially going to have less returns than the previous decade is the fear of high inflation. So right now, inflation has hit a 31-year high. This has implications across the entire economy, but especially for investors and people looking to not lose buying power. Experts say the 4% rule, a popular retirement income strategy, is outdated. And the major reason cited for this is the potential flat market over the next decade, and they cite a withdrawal rate of 3.3% to be much more sustainable. And that quote-unquote safer 3.3% withdrawal rate is essentially the dividend yield of assets like SCHD. And that ties back into the first article, how Bank of America is predicting basically a flat market over the next decade, and that dividends are going to be the main source of income. This article is about inflation's impact on stock returns, and where's the best spot within the stock market to put your money. Numerous studies have looked at the impact of inflation on stock returns. Unfortunately, these studies have produced conflicting results when several factors are taken into account. In fact, let's take a look and see what Warren Buffett has to say about the topic of investing and inflation. So at a 2009 shareholder meeting, Buffett noted that the first best thing you can do to protect against inflation is to invest in yourself and your skills. After that, he says, the second best protection is a wonderful business, which means a company in which the products are in demand, even if the company does have to raise its prices. To me, a great example of this is Apple. Apple is an example of a company that has very strong demand and extremely high cash flow. They have a very impressive moat, it's hard to compete with Apple, and they can charge essentially anything they want. Over time, if you look at the average price of their products, from their iPhone to their AirPods to their Macs, they've all been increasing in price, and people continue to buy them. In a 1981 letter to shareholders, Buffett possibly spelled this out as clearly as ever, writing that companies that tend to withstand an inflationary environment must have two characteristics. One, an ability to increase prices rather easily, without fear of significant loss of either market share or unit volume. And second, an ability to accommodate larger dollar volume increases in business, often produced by more inflation than by real growth. And they can do this with only minor additional investment of capital. Okay, so really quick, what did we learn so far? So most investors, from Bank of America to the poll on YouTube I conducted, are predicting that the next decade in the stock market is going to have subpar returns. A major factor behind this is the risk of high inflation over this period. And in this situation, people like Warren Buffett give the advice of investing in high-quality businesses that have a lot of pricing power. And speaking more broadly about the entire stock market, Bank of America is predicting that dividends are going to be a crucial source of returns over the next decade. In fact, we can dive a little bit deeper into this. So this chart here shows dividends contribution to total return by decade. The yellow is dividends contribution to the return, and the blue is the price appreciation. The last decade, the 2010s, was a great decade for price appreciation. But in other decades, like the 1960s and 70s, dividends did make up a huge portion of the returns, and this is something we might see again this decade. But going one step further, this shows the average annual returns and volatility by dividend policy. We can see that dividend growth companies have the highest average returns of 10%. Non-dividend paying companies have an average return of 2.6%, and for reference, the equal weighted S&P 500 index has a return of 7.7%. So it does seem like dividend stocks and cash flow investing is potentially going to be a good strategy over the next decade. But there are downsides to dividend investing even in this current market condition. And that's highlighted by this article that says tough times for income investors, even with payouts at a record, dividend yields are measly. So in terms of the S&P 500 yearly dividend payouts, we can see that dividend payouts are at an all-time high. In 2017 for the S&P 500, the total dividend payments were $420 billion, and so far in 2021 it's $522 billion. But here's the bad news. So because of the relentless rise in the S&P 500 this year, up about 24% year to date, dividend yields are at 1.3% and are near historical lows. The last time yields were this low was September of 2000 when they hit 1.14%. The long-term average since 1936 is a yield of 3.54%. So this is a bit strange. Corporate America is paying out more money than ever in dividends, but the dividend yields are near record lows. And this is why a lot of people do not like dividend investing, because the starting yield is kept low when the price appreciation is so extreme. And as the article said, that's even with payouts at a historical high. That's how much the price appreciation has been outpacing the growth in earnings. And this chart right here is the EPS, or the S&P 500 earnings over time. And we can see that companies are making more money than ever. And a lot of them are using that for share buybacks as well as dividends. It's just that when you compare that versus the S&P 500 price to earnings ratio, the PE ratio of the S&P 500 has been going insane lately at extremely high levels. So the valuation of these companies is far outpacing even their impressive earnings growth. And that's why if we look at the historical yield of the S&P 500 over the past 5 years, it is decreasing as they pay out more and more in dividends. Okay, so with all that knowledge, what do we do over the next decade if we want to maintain solid returns? So personally, I'm a huge believer in having a balanced portfolio because nobody knows what's going to happen over the next decade. But assuming inflation is going to be an issue and the overall returns are going to be less than they have been over the previous decade, I'm definitely a fan of dividend and income generative assets. These are companies that make lots of money today and they have very strong pricing power. Again, a company like Apple is a fantastic example of this. But that leads us back to the other problem, that the dividend yield is super low in the market right now. And the way that I like to combat this is by using a covered call strategy along with dividends. So you can see I hold Divo, JEPI, as well as my custom covered call ETF. And the purpose of this is to generate higher starting yields. So if we come and take a look at Divo, we can see the starting yield is 4.77%. And if we compare that versus a pure dividend ETF like SCHD, this has a starting yield of 2.8%. Covered call income ETFs do have their downsides. I've made tons of videos on the topic, so check out the channel if you're interested. But considering the macro environment of the economy and the stock market, I personally think this is one of the best options you have, especially if the next decade is going to have lackluster returns. Because in that situation, you're not going to have great price appreciation anyway, and that's the major downside of covered calls. But in a sideways or even declining market, the combination of dividend income and income from selling covered calls could be a great way to maintain a steady level of return even in a shaky market. And the last piece of data I want to show you guys is this one. So this shows the VIX, which is the volatility index, against the S&P 500. And the reason why the VIX is important when it comes to covered calls is because the price of contracts and the premium that you receive by selling covered calls is dictated largely by the volatility of the market. And you're going to notice that there's an inverse relationship found between these two indexes. So when the market is having immense price appreciation, yeah, covered calls do not generate the most income and they're going to limit your upside capture. But when there's more uncertainty in the market and the market is going down, that's when volatility spikes and you can collect more income from selling call options. And I think this chart does a great job of illustrating how when the market is going through rough times, the extra premium collected by selling covered calls can be a great source of extra return. But the topic of inflation and the next decade of investing is definitely very complicated, and I do not have all the answers, so definitely let us know your thoughts and opinions in the comments down below. If you're still watching and enjoyed, definitely give the video a like, subscribe to the channel, all that YouTube stuff, it's greatly appreciated. But I'll see you guys in the next one.